You are on hold with your bank. Same logo, same app, same building, same polite automated voice telling you that your call is important. But somewhere inside that same system, another version of you is not waiting. That version of you has a direct number, a dedicated banker, a different card, and someone who already knows why you are calling before you explain it. The difference is not your character. It is not how hard you work. It is not how badly you need help. It is the number next to your name. And once that number gets big enough, something strange happens. Banks get warmer, lenders get faster, advisors get curious, friends get careful. Family gets comfortable asking. Opportunities stop hiding. So the question is not just how much money changes your life. The real question is, at what net worth does the world start treating you like a different person? The first clue is usually small enough to miss. It might be a $17.50 monthly service charge sitting quietly inside your checking account. Not enough to ruin you, not enough to change your month, but just enough to reveal how the system works. You walk into the branch, ask about the charge, and the answer sounds ordinary at first. It is a standard fee for your account type. Nothing personal, just policy. Then the banker looks again. They see the assets you hold with the bank. Suddenly, policy gets softer. The fee can be waived. Maybe not because the account changed, but because you did. Or more precisely, because your balance sheet did. That is the first uncomfortable truth. A bank may not value you based on how much you need the fee waived. It may value you based on how much it wants to keep you. And this is where the first level begins, around $100,000. At $100,000, you are not rich in the way television defines rich. You are probably not flying private. You are not buying vacation homes in cash. You may still compare prices, wait for sales, and think twice before upgrading your car. But to financial institutions, you have crossed a quiet visibility threshold. You now look like someone who can keep deposits open. Investment accounts, take out a mortgage use premium credit cards, and grow into a more profitable client over time. You are not just a customer anymore, you are future revenue. That is why around $75,000 to $100,000 in assets at one institution, bankers may start paying closer attention. Higher tier accounts often have minimums around $20,000, $50,000, or $100,000 and above. In exchange, you may get waived service fees, dedicated support, lower lending rates, or introductions to wealth managers. The fee waiver itself is not life-changing. Saving $20 or $35 a month will not make you financially independent. But the message behind it matters. The system is saying you are now worth retaining. That same signal starts showing up in other places. Credit card issuers may begin sending you pre-approval offers you did not ask for. Not just basic cards with forgettable limits, but premium cards like Chase Sapphire Preferred American Express Gold or Capital One Venture X. These cards may offer 2% to 4% cash back in certain categories, travel rewards, lounge access, hotel perks, or other benefits designed for people who spend consistently and pay reliably. The irony is obvious. When you need credit most, you often have to chase it. When you need it less, it starts chasing you. Car dealerships respond to the same pattern. By the time your net worth reaches $100,000, you may have a stronger credit profile, a better debt-to-income ratio, and a longer history of paying bills on time. That does not mean every dealership becomes honest overnight, but it does mean the conversation changes. You are less likely to be treated like a financing problem that needs to be solved in the back office. You may get approved faster. You may qualify for better rates. On a $30,000 car loan over 5 years, the difference between 5% and 7% interest can be close to $1,700 in interest. That is not a theory. That is the cost of being seen as slightly less risky. And risk is the language institutions understand. Even financial advisors begin to notice. If you have $20,000 or $50,000, you may be directed toward a call center, a robo-advisor, or a simplified service model. At $100,000, you may finally qualify for a more personal conversation. But this is where the story gets more complicated. Being noticed is not the same as being prioritized. At $100,000, you may still be one of the smaller portfolios in an advisor's book. A traditional asset-based fee can feel heavy relative to what you have. So yes, you may finally get access to advice, but that does not automatically mean the advice is worth the price. That is the first level. At $100,000, you become visible. And visibility does not stop with banks. Your friends may not know your exact net worth, but they can feel the difference. You are calmer at dinner. You do not panic over every bill. You may be maxing out a Roth IRA. You may have enough discretionary income to enjoy life without turning every purchase into a crisis. Eventually, you become the money person in the group. People ask what card you use, what account they should open, whether they should invest, whether they should lease or buy. Some people are proud of you, some quietly resent you, and without meaning to your financial stability, begins to reveal the emotional stability of the people around you. Then comes the second level, $1 million. At $100,000, the system notices you. At $1 million, the system starts pursuing you. This is where banks stop thinking only about your checking account and start thinking about your entire financial life. Deposits, investments, mortgages, lines of credit, estate planning, business accounts, future inheritances, future loans. Many major banks have private client programs for people around this level. JP Morgan, for example, offers private client-style relationships with dedicated bankers, wealth strategies, and access to certain events or experiences. Some people describe these services as nice to have, but not essential. Maybe you get a different debit card. Maybe the phone number on the back routes you somewhere faster. Maybe you can walk into a nicer branch in downtown San Francisco and speak with a relationship banker who is helpful, pleasant, and not always necessary. But necessity is not the point. The point is that the bank is no longer treating you like a transaction. It is treating you like a relationship worth defending. At $1 million, financial advisors also change their behavior. You may not need to search for them as much because they start searching for you. LinkedIn messages, emails, phone calls, free portfolio reviews, invitations to dinner, golf, client appreciation events. The pitch changes because the math changes. A 1% advisory fee on $1 million is about $10,000 per year. That is real money. For that fee to make sense, an advisor should be doing more than telling you to buy an ETF and wait. They should be helping with tax strategy, estate planning, retirement income, risk management, and coordination with your CPA or attorney. At this level, you are no longer paying for stock tips. You are paying for coordination, judgment, and fewer expensive mistakes. But money also starts changing social expectations. If people know or even suspect that you are a millionaire, some may assume you can afford things you never offered to pay for. A family member might expect you to pick up the bill. A friend might ask you to invest in a business idea. Someone may treat your emergency fund like their backup plan. And this is where wealth becomes socially awkward. You may still feel like the same person. You may still remember being broke, anxious, or careful, but other people may no longer relate to you that way. If you are not worried about a $1,000 emergency expense while someone else is an invisible distance can appear in the conversation. You did not ask for the distance, but the number created it. Then there is the third level, $5 million. This is where the entire dynamic flips. At $100,000, you become visible. At $1 million, you become valuable. At $5 million, you become access. The difference then is no longer just better service. It is access to rooms, people, deals, and systems that ordinary customers never see. Private banking at this level can stop looking like banking and start looking like infrastructure for a complicated life. Institutions such as JP Morgan Private Banking or Goldman Sachs Private Wealth may offer services that go far beyond accounts and loans, depending on the relationship. This can include lifestyle support, coordination around tax and estate planning, help with art and collectibles, luxury travel, private aviation, or even finding people who can help manage bookkeeping, payroll, and household financial operations. That is a different universe from calling about a $17.50 fee. At this level, advice also changes. The conversation is no longer simply, how do you build wealth? It becomes, how do you preserve wealth across decades? Taxes, heirs, lawsuits, bad decisions, and time. That may involve trust tax planning, charitable strategies, business succession, and multi-generational wealth planning. You may also begin hearing about private equity hedge funds, venture capital, or pre-IPO opportunities. Some opportunities require certain legal investor qualifications because regulators recognize that these deals can be higher risk, less liquid, and less transparent than public market investments. This is an important point. Access is not the same as safety. A private deal is not automatically a good deal. Sometimes exclusivity is valuable. Sometimes it is just expensive packaging. But the social reality is still clear. At 5 million people with deals may start finding you. Real estate agents may show you off-market properties before they ever reach Zillow, Redfin, or the MLS. Developers and brokers may ask whether you want to invest in commercial projects. Founders may pitch startup ideas and ask for a check of $10,000, $25,000, or $50,000. Friends may not just ask for advice anymore. They may ask for introductions. You become a person other people want in the room, and that is powerful. But it is also lonely in a very specific way. Because once your money becomes visible enough, you have to ask a question you never wanted to ask. Who is here for you, and who is here for what you can open? Money does not define your character, but it does attract characters. Some are sincere, some are ambitious, some are desperate, some are calculating. And the more access you have, the harder it becomes to tell the difference immediately. That is the hidden cost of being treated differently. At the beginning, you were just waiting on hold with your bank. By the end, you realized the hold music was never random. It was a routing system. Every customer was being sent somewhere, not by kindness, not by need, not by effort, by how profitable they appeared to be. So the 3 levels are not really about luxury. At $100,000, you become visible. At $1 million, you become valuable. At $5 million, you become access. And maybe the strangest part is this. The more help you can afford to live without, the more people offer it to you. Comment one word below: visible, valuable, or access. Which level do you think changes people the most?